Hello, my name is Maria Bezubova and you're at my channel Fertilizers Jazz. Here we talk about events, trends, technologies in the world of fertilizers and agriculture. Please subscribe to the channel, put like to this video, and let's jazz. Today is March 17 and this is a weekly markets update. Let's have a look at the news of week 11 and see what are the next trends. Urea market lacked liquidity last week across the globe. Indian tender hasn't emerged again, weighing more on market prices. Most of the producers stayed on the sidelines in an attempt not to let prices slip further. Northern African values dropped as low as $400 to $420 FOB, but there was no business. Also, there were no sales conducted from Nigeria, where next sales tender is expected to emerge. Spot prices in the Middle East decreased to $394 $400 CFR, but again, there were no sales. Iranian producers are coming back on stream. At the moment, most of the plants resumed production, but reaching full capacity will take about 2 more weeks, perhaps. Turkey and Brazil will be the outlets for first batches, as both markets haven't received their target shipments from Iran before gas supply curtailments. News about Iranian production ramping up also weighed on prices in Southeast Asian markets. Russian producers in Baltics built length, and prices dropped last week to $355 to $70 FOB for prilled and $10 higher than that for granular. Lack of demand from Latin America makes producers nervous about April volumes to be placed. Demand in Europe was rather slow due to unfavorable weather conditions in certain markets like Italy and Spain, and general uncertainty about the short-term price trend. CFR prices dropped by $10 to $20 in all ports. In the US, prices dropped by $5 per short ton to the level of $380 to $85 FOB NOLA. However, the sentiment is very nervous for April. There is clear understanding that there will be a need in at least 1 million tons imports during April and another 700 to 800 tons at least in May in order to cover demand from the farmers increasing their corn acreage. At the same time, importers are not purchasing now, waiting for lower values, which might play against them as soon as Indian tender will emerge. The general market expectation is that the rush for tons will open very soon and prices will skyrocket inevitably. But first we need to see Indian tender materializing, of course. Another problem for US farmers might be introduction of retaliatory tariffs by European Commission for US corn as of April 1st, as well as soybeans and durum wheat later. That is already under discussion. It will be a response to introduction of 25% tariff for EU aluminum and steel products. The US was supposed to send around 2.5 million tons of corn to EU during this marketing year, which is a big chunk, around 20% of total EU corn imports. Tariff war obviously is a painful experience for all participants. Let's see how it develops further. Paper values dropped again across the benchmarks. Egypt FOB future price lost $10 for March and 2 months ahead. NOLA values corrected to the average of $380 per short ton for March, $370 for April, and as low as $342 for May. Arab Gulf FOB future price decreased by $5 for March and May, and by $10 for April, where the most of uncertainty is concentrated, of course. Brazil CFR also dropped by $10 for March and April and by $5 for May. In ammonium sulfate market, bearish sentiment was emerging due to softening trend in urea. In China, standard grade Amsul corrected downwards by $5 to $140 to $43 FOB. Producer TCC closed a tender for 10,000 tons for shipment by April 20 at mid-140s level. After that, SCC producer held a tender for shipment up to May 15. The total volume might achieve 30,000 tons, but this is unconfirmed. The tender resulted in an average price of $142 FOB. Compacted product values also decreased to around $150 FOB level. In Thailand, TCCC closed an import tender for 12,000 tons of standard AMSU. The offers heard net back to $140 FOB China level. In the Philippines, Atlas issued a fresh import tender for 6,000 to 12,000 tons for April shipment. In the US, decrease of urea price weighed on price of granular AMSU as well. There was no major business done, but indications moved down to $400, $410 per short ton FOB NOLA level. Activity in European markets is minimal. The region is entering off-season now. European producers will enter into regular maintenance, which will not affect shipments to the US, though. Still, several granular cargoes are expected to sail to the US in April. The nitrates market has slowed down in Europe. Farmers are focused on application. Also, many are deferring purchases in the hope that nitrate prices will come down. Nitrate prices indeed are under downward pressure due to softening trend in urea and gas values retreating from season's highs. But producers are trying to hold out on any pricing action for as long as they can. In Germany, CAN prices are holding steady at 370 euros CPT. In the UK, CF is the only producer to have raised offers. For May, it is offering ammonium nitrate at £5 higher over April offers. Urea application is almost over, and now farmers are asking for urea. In Germany, Escava Pisteris started its second ammonia line. Nehim in Bulgaria has also resumed operations after a technical issue that lasted several days. UAN demand in Europe was not very active last week, mostly due to unfavorable weather conditions. Prices remained largely unchanged in front of the final round of demand. For now, situation in the UAN market seems to be unaffected by softening in urea. In the US, it was similar. Prices were unchanged both at NOLA at $290 per short ton FOB, as well as in the inland terminals at around $330 per short ton. Inland purchasing activity is steadily growing and will further increase in upcoming weeks. In ammonia market, the sentiment remains very bearish, with production continuing at high levels with low demand in Asian markets. At the same time, demand from European markets is healthy, supporting current price level. Thus, last week, spot business in Southeast Asia was heard lower. A quantity of 15,000 tons has been concluded at as low as $300 FOB for March loading at Lubuk. But this is unconfirmed. Previously, Southeast Asia FOB prices had been assessed at $310 to $40 FOB level. Some market players indicated that these levels are not sustainable, given costs of production. So perhaps we are indeed approaching price floor. In North Africa, there are indications of price drop $5 to $10, which would mean that Northwest European prices to adjust accordingly. However, the market awaits confirmation of the first deal for April shipment to see the actual level. In India, it is understood that FACT awarded its February 28 purchase tender for 8,000 tons of Middle Eastern material to a trader at around $375 CFR for arrival around mid-April. Also, FACT issued a purchase tender closing today for the same 8,000 tons each, cargoes for May and June delivery. In phosphates, there is still no deal with OCP on the table, as Indian buyers are still in discussions with the Moroccan producer. News in India last week involved NPs and PKs rather than DAP. RCF has received 2 offers under its purchase tender for NPS and NPK, which closed on March 10. One offer is rumored to be from Hexagon for 30,000 tons of NPS of Chinese origin, and one from Chasemax for 40,000 tons of NPK 1515 of Russian origins. Both deals are unconfirmed, though. Price bids will be opened next week. Chinese DAP is still offered at level $630 to $40 FOB, although there are concerns in the market that some Chinese producers might not make the April window to export, and export permits have not been issued yet. In Brazil, MAP price moved up to $640 CFR, however, no major business was concluded. There is still significant interest in SSP, which is evaluated at $215 CFR, while TSP held at $500 to $505 CFR. There were not much news in the US last week. At the beginning of the week, DP trade was heard at $618 per short ton FOB. Other than that, the week was uneventful. Moving to the fundamentals. European natural gas futures rose over 8% during past week, ending a 4-week losing streak, as colder weather increased heating demand and the market monitored potential ceasefire talks between Ukraine and Russia. Concerns persist over Europe's ability to refill gas storage ahead of winter, with current levels below 36% and 90% target set for November 1. Hopes for a quick end to the Ukraine war, which could restore Russian gas flows, remains low. US natural gas futures, on the contrary, dropped over 8% from the Monday peak, pressured by near-record output and forecasts for milder weather over the next 2 weeks. Production in the lower 48 states rose to almost 106 billion cubic feet per day in March, surpassing February's record. However, gas flows to LNG export plants also reached 15.6 billion cubic feet, matching last month's record. Storage levels still remain 27% lower than the same period last year and 12% below the 5-year average. Agricultural commodities future prices restored after a significant decrease at the beginning of last week. Wheat futures climbed above $5.50 per bushel, touching their highest level since February 26th, as investors welcomed signs of strong international demand. The USDA's latest weekly export sales report showed US wheat sales surged by 84% above the prior 4-week average and exceeded expectations. However, on the supply side, Statistics Canada reported that Canadian farmers plan to expand wheat planting in 2025. And also, latest WSDE report indicated larger output and ending stocks for 24-25 season, mostly due to significant increase of Australian production, almost by 2 million tons versus February evaluation, as well as significant upward correction of Argentinian harvest amid favorable weather conditions. That might drag global prices down. And continuous uncertainty remains around escalating trade tensions, of course. Corn futures also rebounded to $4.6 per bushel, supported by tighter global supplies and trade uncertainties. WSD report showed a 1.4 million ton decline in global ending stocks, driven by lower inventories in China and Argentina. While global production is forecast higher due to gains in India, Russia, and Ukraine, output in South Africa and Mexico is set to decline. Meanwhile, trade tensions with Mexico, the top importer of US corn, are easing. Soybean futures hovered around $10 per bushel, attempting to recover from a recent sell-off after Argentina lowered its production forecast below USDA estimates. Argentine soybean output for 24-25 season is now expected by 1 million tons lower versus February evaluation, as drought impacts persist despite signs of recovery. And in support, the USDA's weekly export sales report showed stronger than expected US soybean sales, with China leading purchases. Moving to the shipping industry. 8% seems to be the figure of the week. Containerized freight index lost 8% more versus a week ago. Again, as a week ago, price decreased for all key destinations, with sharpest drop for destination from China to US ports. Market analysts foresee further price deterioration as shipping capacity increases. Interestingly, current composite index level is still more than 60% higher versus pre-pandemic average in 2019. The Baltic Dry Exchange Index increased again last week. Upside was evident across segments and geographies. In the Capesize market, the positive momentum was building from midweek onwards, as activity increased and tonnage tightened in both basins. The Panamax market brisked up midweek with rates surging as a strong push in the Atlantic market, both South and North America, led the drive. Then the market witnessed a number of fixing from South America East Coast, and this in turn gave additional support to the Asian market. In ultra-supramax segment, there was stronger demand from the Asian arena. The Atlantic remained somewhat of a mixed sentiment. In handysize segment, only modest fluctuations were registered across both basins. To sum up, the bearish sentiment in urea continued and weighed on the whole nitrogen market last week. All market players are tired of guessing when the Indian tender finally emerges to support the deteriorating values. Thus, market was in kind of limbo. Demand in Europe was sluggish, anticipating the wave of refill purchases, while US market is in front of significant purchasing activity that most likely will coincide with India's entrance to the market. So, April is expected to be unprecedentedly hot in nitrogen. Nitrates application is almost finished in Europe, so no new demand will arrive. Sulfate price was also decreasing on the back of softening urea and of season in key markets. Phosphates prices remained high and even increasing in certain markets. Ammonia supply continued to build up in the east, pushing FOB price level further down, perhaps already close to the floor, while healthy demand in Europe supported current price level, at least for now. European gas price rebounded a bit due to colder front arrival to Europe, but it will not last long. In the US, situation was vice versa, with warmth spreading across the country. Thus, gas price retreated from the recent highs. Agricultural commodities future prices rebounded more amid very healthy international sales in past weeks. Container shipping costs dropped more, while in bulk shipping, the momentum returned to the market across geographies and shipping segments. So, let's see what is next around the corner. But it will be already next week. Thank you for watching. Please subscribe to the channel, put like to this video, push the bell in order not to miss any updates, and see you soon.